So this week we've seen a continuation of the outperformance of the FTSE 100 against 250. The 2 days after Brexit, we saw the biggest ever on history outperformance of FTSE 100 against 250, and that is a reflection of the structural overweight that UK funds had in mid-caps, which they're now unwinding to address the underperformance we're seeing. Also, we're seeing defensive stocks outperform against cyclicals. Here's a chart of defensive against cyclicals, show 15% outperformance in the United States since November 15, as that index has followed the 10-year yield down as yields have continued to be compressed. This week we saw further evidence of why yields are falling, and here we've got a chart that shows the structural shift down in the yield across the curve since the start of the year. And that's been reflective of comments from both central banks in the UK and the US. So this week we had Governor Carney talking down the UK economy quite aggressively, trying to get ahead of the curve in terms of spelling out the potential problems that we will see. That impacted sterling alongside the gating that we saw for property funds in the middle of the week. We also had Fed minutes for June pre-Brexit, so more dated than usual, but we did see a pushback on the typically optimistic scenario analysis we see from the Fed, and getting more realistic about the achievability of that 2% inflation target. So we saw Fed Chairman Dudley suggest that he didn't see any reason why rates would go up in 2017. They remain data dependent. However, the data has not been that bad this week. We saw two good pieces of ISM data coming through, and we got an ADP jobs number yesterday that was fairly strong. So we go into the non-farm payroll this afternoon looking for a reasonable figure. We also have seen average hourly earnings tick up over the last couple of months. So within portfolios, we're continuing to try and position for a situation where average earnings are going up, so we're insulated from that. And equally, at some stage, we've got insulation when the yield curve does start to pick up. So it'll be very interesting to see how the yield curve responds to the jobs number this afternoon. Looking at the week ahead, we've got Taylor Wimpey on Monday. We'll talk a little bit about that. ICAP on Wednesday. And then we go into the start of the US reporting season. So we've got the big banks starting on Thursday with JP Morgan. And we've got Wells Fargo, which is one of our house names, on Friday. Just looking at the preview for the banks, for Wells Fargo, the key point is what the yield curve is doing. Clearly, that reduction in the yield curve has taken some earnings off consensus estimates over the last couple of months. We had about a 5% downgrade. So we'll see what they can do on expenses to counterbalance that. We've equally had the Fed stress tests, which have passed these banks to start paying more away to shareholders. So we'll get more commentary on that, whether we're getting bigger buybacks and bigger dividends as a result of that, using their very strong balance sheet. We also have Goldman's, not next week, but the following week. And here, it's slightly more optimistic. It's following a pretty poor quarter last quarter. High yield spreads have increased. Equities are generally higher. So we should see an increased mark-to-market valuations, which is good for Goldman Sachs. Equally, volatility has picked up. They tend to do well in higher, more volatile markets, and the IPO market has been fairly healthy in the second quarter. Equally, we'll probably see more expense control in coming out of Goldman's as well as Wells Fargo. Just talking about Taylor Wimpey briefly, because clearly that has been in the eye of the storm. We'll get a little bit more information about that on Monday, but we see that the base yield of 4% looks very payable. So the stress test on that is for a 30% fall in volumes and a 20% fall in average selling prices, which is a fairly ground zero scenario for Taylor Wimpey, given it is a nationwide house builder. Unlike in 2012 and 1996, the business goes into the sort of peak of the cycle ungeared. So we feel that they're in a far better position to pay the ordinary dividend and sustain that special dividend, which would bring the total annual dividend to 12%. That's it from me. Thanks for listening.